Good afternoon, ladies and gentlemen. It's my pleasure to be here addressing you today. Let me start by putting a few points across before handing the call over to Harshil and the team for their comments. As you all would have seen, the last 60 days has witnessed unprecedented liquidity tightness across the entire HFC and NBFC space. DHFL, in its more than 34 years of existence, has seen multiple credit cycles and weathered numerous market events only to come out stronger from each. We have treated each of these events as a learning opportunity, realigned business strategy as required, and grown with even more vigor and profitability. Our learnings from this event necessitate that we realign certain parameters to play to our strengths, and I, along with the team, will tell you what we will be doing. However, before that, I wanted to touch upon how we have successfully managed to tide over the liquidity squeeze over the last 2 months. Since 24th September, we have repaid liabilities of nearly 14,000 crores, which includes more than 9,000 crores of CP repayments. This was indeed a Herculean task, which we met through internal liquidity generation and minimal external borrowings. The power of our low-ticket retail housing portfolio with pristine asset quality is evidenced through net sell-down assignment of more than 7,400 crores of retail assets in a short span of 50 days to 8 banks and financial institutions. This, indeed, will be one of the biggest advantages that DHFL will continue to emphasize going forward. I think it's pertinent to also mention some of the key strategic initiatives that we intend to take by March 19. And I'd like to enumerate, bullet it as follows. Repurposing DHFL to be a completely retail-focused housing finance company. I think capital efficiency and liquidity generation through continued sell-down of retail loans will become a strong business model for DHFL going forward. Bringing down the project finance portfolio to less than 10% of the book. Divest non-core investments to bring in non-dilutive capital. And also look at the possibility of how we can, at the right value, generate ring-fence DHFL from exogenous shocks by raising additional equity, obviously at the right time. Over the medium to long term, we are aligning the organization to deliver consistent profitability with ROE as the key focus. Over the next few weeks, we will come out with a roadmap outlining all details. I think this was just a brief for me. Rest of the events are well known to all the participants here. As regards the quarter, I would now like to hand over the call to Harshil for taking you through the Q2 performance and his thoughts going forward. Thank you.
Thank you, Kapil. Good afternoon, everyone. I once again welcome you to the Q2 FY19 investor call of DHFL. As already mentioned, I have with me Santosh Nair, our Chief Business Officer, Vivek Kannan, our Chief Operating Officer, Rajendra Mirashi, President, Project Finance, Santosh Sharma, our CFO, and Bharat Parikh, who heads our Treasury, along with Pranab Goel, who heads Investor Relations. The events of the last 2 months have been a big learning for the entire sector. As you all are aware, DHFL has always focused on retail affordable housing loans in the outskirts of metro and Tier 2, Tier 3 locations. Over the last couple of years, the company has been undergoing a complete transformation in how we source and process loans, which give us the confidence that we are well placed to implement our retail-focused strategy in a profitable manner. As our CMD has just mentioned, DHFL will now move forward being a purely retail financing company. Let me illustrate the strength of our retail franchise with some pertinent data points about incremental home loans. 90% of our loans have ticket size which is less than 30 lakhs. 23% have a very high bureau score of 750 plus. 62% have a high bureau score of 650 plus, and 25% are first-time home buyers in new to credit. On the overall home loan portfolio, more than 90% has a fixed obligation to income ratio of less than 60, while more than 60% has a LTV of less than 75% at the time of origination. Do note that these are at the time of origination, and with the seasoning of the portfolio, this ratios only improves. This clearly shows that while we have built capabilities to process ever-increasing number of retail loans, we have also ensured that the asset quality remains top-notch. How do we see ourselves going forward is the most pertinent question which most of you will have on your mind in this call. For one, with liquidity in the market expected to remain relatively tighter and consequently higher cost of funds, the growth levels will moderate compared to the previous quarters, but this will enable us to price the risk more effectively. Our state-of-the-art central processing units, which some of you would have already seen functioning, along with the effective use of technology and fintech tools to underwrite will ensure continuous operational efficiencies in retail loans. The fact that we have been able to sell down nearly 8,500 crores of gross loans and more than 7,400 crore of net loans in just 50 days is a testimony to the asset quality, as it also clearly demonstrates the comfort that the banks have with our underwriting as well as the collection processes. Going forward, securitization will be a key source of funding. Our learning from the loan pools that we have securitized will be used to ensure that we generate retail loans which can be easily securitized, which, besides providing liquidity, will be ROE accretive and also release capital. Our understanding of the affordable housing market will enable us to design products and focus on those segments which can give us additional yields while ensuring that there is no slippage on quality. Our wide national presence as also effective use of ground serves the retail loan festival in smaller locations will ensure a high brand recall for us, thus furthering ensuring that we will be able to attract quality customers. We have held 39 such ground serves in the first half of the year and over 31 that we did last year. We have already received PMAY subsidy of close to 250 crores, have submitted another 290 crores to NHB and have another 779 crores under process. The number of our customers in our sourcing that are eligible for PMAY subsidy is a testament to our focus on our target segment. Now let me give you a quick update of the quarter that went by. First of all, it gives me great pleasure to inform you that we have leased out 3 of the 8 floors in the BKC office building that it has now become income generating. Discussions are on for further 3 floors and we will keep you updated as and when more floors are leased out. In terms of business, we ended the quarter with an AUM of rupees 1,30,182 crores, up 39% year-on-year, within which our home loans grew 23% year-on-year. Total disbursements were 13,870 crores, up 39% year-on-year. Our retail liabilities continue to show excellent traction and grew 29% year-on-year, contributing 10% of the total liabilities. Our NIMs were at 3.15% vis-a-vis 2.92 in Q2 of FY18. Our cost-income ratio it was at 22.3 vis-a-vis 22.12 in Q2 of FY18. The asset quality continues to remain strong with a stage 3 assets of 0.96%. With this, we now open the floor for any questions you may have with respect to the financial performance for Q2. Thank you very much.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Prashant Kuge from Edelweiss. Please go ahead.
Yeah, this is Kunal over here. So, firstly, in terms of disbursements, if we have to look at it, how things have been post-September. So, our quarterly run rate has been, say, somewhere around 4,500 crores per month, monthly run rate. So, where are we? In fact, was there any disbursements in the month of October, November, and how do we expect it to pick up? So, that's broadly the first question. And secondly, in terms of the developer books, you highlighted that we would want to run it down to the extent of 5% odd. So, finally, maybe what is the overall tenor? How has been the performance of this entire book in terms of like year to date?
So, as far as disbursements are concerned, in line with what all of us have experienced in the industry, the disbursements did take a back seat considering the liquidity position. So same was the case with us. The disbursements were predominantly around the committed disbursements to customers who had already taken loan and had part disbursements. Going forward, even in the month of November, as we see, the disbursements continue to be subdued. And going forward, we are reassessing the entire situation as to how the liquidity pans up, because we are all also aware of the fact that the RBI board meeting also happened, and there are indications that the liquidity may improve. But yes, going forward, the growth rates what we have experienced in the past, and to that extent as recent as in Q2, is not something which we are going to see, and that is what we have highlighted as a part of our strategy also, that the growth rates are going to be subdued, but at the same time the focus will be more towards higher yields so that it becomes highly accretive. We would be in a better position to give the guidance maybe by next quarter in terms of how it looks like in terms of the growth opportunity in the disbursements.
But just in terms of the monthly run rate, so 45 days in this particular quarter, how has been, so have we done any disbursements? So definitely project loan, it will be zero kind of disbursements. But on the retail, are we doing anything maybe from the past sanctions or even incremental sanctions? How has it been?
So, have we disbursed in the month of October? Yes, we have disbursed in the month of October. Have we disbursed in the month of November? Yes, we have disbursed in the month of November. Are these numbers worth talking about? I don't think so, looking at the kind of the numbers which we have always faced. Are we in line with what you have experienced in the industry? I would say yes, that this is how the industry also has done the disbursements, because we know what disbursements are happening, whether it is NBFCs or HFCs. So the bottom line is that it's not that we have stopped disbursements completely, as you would have heard in the market for some players. There has been disbursements which has been going on, but it is extremely controlled.
Yeah, and in terms of the project loan book, what is the kind of performance? Have we seen any kind of stress in this 22,000 crores kind of book which is existing? And if we run it down, how would that overall transition be? Do we expect any kind of increase in the delinquency levels out there?
In project finance, question, hello?
Can you repeat the question, please?
No, so on project financing side, how has been the performance on this entire 22,000 crores of a book till date? Are we seeing stress in any of them? And if the plan is to run it down to say 5% or less than 10%, then how do we expect that transition to be? Would we see any major stress out there, rise in delinquency levels in this particular portfolio?
Yeah, on the project finance, I could say that we haven't had any major delinquencies. However, the cash flows are getting a little more staggered. As you know, the type of lending is that we give what is called as a pre-EMI stage, when only the interest is serviced, and the post-EMI stage, which is normally when the cash flow from the sale starts getting accelerated. It's normally 36 plus 36 months, or it is 48 plus 24 months kind of a situation. Now, largely we used to see around 30% of the book getting run down during the pre-EMI stage because the sales velocity used to be very high. That has completely shifted to the back-end position, which is what is a little discomforting feature in as much as the cash flows are not coming in as originally indicated. Resultantly, the interest payout is also going up a little. But overall, the book has behaved very well. We have had very little delinquencies that have come in the recent past. Now, that's as far as the quality and the flow of the book is concerned. As stated by the chairman in his opening speech, we are now working towards ensuring that we become a complete retail-oriented company and would like to keep the project finance book as low as possible and in a phased manner exiting it completely. And there is a committed effort that's going on because we have had two kinds of projects which are linked to SRA-related developments in the central Bombay area, in the Bandra Kurla area, and we have also had a project across the country in different locations. Taking the pool together, there is a tremendous amount of interest that has come in the market with regards to the projects where we are invested some time back with our various developers across the city. And we expect to see that our project finance portfolio comes down significantly from the existing level of about 22,000 crores to as low as possible in the given time frame. Particularly by March, we would like to have a benchmark level of some 9 to 10,000 crores or so, and then take it further down over a period of time. That's the way we look at the project portfolio. And if the question, if I have to answer it before someone comes, is how are we going to mitigate the returns on this project finance to other business? We have a business plan very clearly in place as to how do we strategize in terms of retail growth, how do we maximize the interest return, and how do we mix and match the cross-sell and fee earning that will more than compensate the loss of income from the project finance. That's, in a nutshell, what I would like to submit on the project finance.
Okay. Yeah. Thank you, and all the best.
Thank you. The next question is from the line of Anirban Sarkar from Principal Asset Management. Please go ahead.
Yeah, hi. Thank you for the opportunity, sir. So just extending from the previous question itself, so you have said that you intend to bring down the proportion of project finance to around 5% of your book. Now, if we do the math, it would take almost bringing down your disbursements in project finance to zero in order to achieve that kind of reduction in the book proportion. Given your retail book grows and the project finance you don't disburse anything, in that case, it can come down to 5% in a few years maybe. So, how does this work? I mean, if you stop disbursing, some of your borrowers might actually face liquidity issues and it might worsen the situation for them. So in that case, could we see defaults arising from that part of the book?
It is a good question. I would answer it this way, is that we have, as on date, the projects where the disbursements are yet to take place is to the extent of 3,200 crores or so, of which those which are falling due for disbursement between now and December to March is roughly of the order of 200 plus 300, 500 crores. Now, these are bare minimum disbursement that we need to make to see that the project keeps going on in their normal growth, and that we will try and see as to how do we accommodate within the given cash flow. During this period, we expect to see that we are able to enable the developers to either migrate to a new lender or have a consortium lending, or alternatively, we are also looking at options regarding creating an AIF structure wherein we could move this project finance and see to it that the developers are able to raise NCDs, CCDs or OCDs from the market in the AIF structure to continue the growth. So we will see that we handhold them. We are not going to let them down because that should be very critical. But we do not envisage any delinquencies because we do not disburse. If it comes to that, we will see to it that those critical amounts will keep disbursing. And if the transition phase, as I told you, the desired destination is 5% of the AUM, we should be reaching somewhere closer to that by March. But June, September coming, the entire transition should take place very successfully, with all cautions to see that none of the ongoing projects have any kind of delinquencies.
All right, fair enough. Sir, and one more question. I just saw on the, there was an interview on the TV, and I saw a comment on changing the business model of the organization and working more closely with banks. So, how should we read into this? I mean, is there any further explanation you want to provide us with to understand what exactly you're referring to?
Yeah, so what the chairman was referring to, and what I also mentioned in my opening remarks, is around the business model of sourcing and the kind of retail granular level portfolio which has been built. So more and more, now that we know when we have done the securitization with various banks, we are also now aware of the fact that what kind of loans, what kind of profile, segments, market is more preferred. And hence our business model will to that extent align itself with the sourcing, so that more and more which you source becomes eligible for sell down purposes. And continue to focus on the segment where we are.
All right. And by sell down, you mean more of direct assignments where it does not stay on your books?
Yeah, correct.
All right, fair enough. Thank you, sir. Thank you.
Thank you. The next question is from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Good afternoon, sir. In this environment, when everyone is really worried about real estate lending, how confident are you about your ability to actually sell down portfolio or bring in other banks or NBFCs in the book that you have built on the project finance side?
Yeah, as I told you, we have actually compartmentalized this into two segments. One thing you need to appreciate is that in almost all the project finance that we have lent, we are the sole lenders. So there is a tremendous amount of flexibility available to us in terms of negotiating and selling it down. We have classified them into two categories. Those are projects which are SRA-oriented, wherein most of the clearances have come in and the project SRA part of it is complete. So there is a tremendous amount, and they are located in a pocket with continued demand in terms of mid-priced homes. And that's where we are looking at some great interest from leading developers, both from the city who have been in this metro as well as those who would like to enter this city. I won't be able to give you the details, but our game plan is very ready that at least 10,000 crores of our project finance, that is close to 50% that we are talking about, is very much ready for being taken out by developers because they have a major potential for development, particularly with the 4 FSI that has come in. When we actually funded this project with the developers under the circumstances of 2 FSI, now they are moved into 4 FSI, and there's a huge amount of potential available both in terms of developing here as well as encashing the TDR part of it. And since that is readily available, there is a huge amount of interest. So that's where we are a little more confident that notwithstanding the kind of pressure that we are seeing in the market by many players to sell down their portfolio of developers, we will be able to do it quite confidently within the time frame and in the manner that we have indicated.
So these SRA projects, what stage are these projects in and what actually you have funded?
The stage of completing the SRA and the sale component is getting ready. I mean, it will be a little tedious for me to get into the details, but then the 80% of the SRA road has been completed. I mean, the SRA part has been completed. The sales are in the starting stages right now. Normally the builders, there is an interest for joint development to come in once the SRA part is halfway through. So these are all in the stages where the joint development interest has come up substantially, and that's where we are very confident that the builders will be able to pay off our loan and go into a joint development kind of a funding arrangement.
So you have funded the SRA part of the project, basically?
We funded the developer as a comprehensive listing of an SRA, but then our objective at that time when we listing was to wait and watch to see as to whether we could continue to be a part of the overall sale development or we would like to exit it. Going by the current situation and the stance that we have explained to you in terms of refocusing on retail, we would like to exit them.
And sir, this quarter you had repaid around 13,000-14,000 crores and mobilized around 11,000-12,000 crores. So net you have disbursed on a net basis negative in the sense there has been a sharp decline. So you are not on a net basis mobilized anything, actually prepaid. So when do you think that on a net basis you will be able to mobilize money, or this is when all these things are likely to normalize and you don't need to sell down loans to banks for funding?
So, first of all, basically the sell down is our business model. It is not that sell down we have done in this quarter only. If you look at our sell down book, which is quite large book, and this has been the model for the funding. The only thing is that these 2 months, the sell down has been more because we had that much stock. And many times we have already clarified that one of the source of the funding is sell down. As far as your other question that how will we source the fund, so other than sell down, we have also received the funds by way of NCD from bank and financial institution. And you will appreciate that in spite of this all, tight position, we have been selling to, and going forward, we don't see any much problem from the bank funding or NCD or whatever the source of funding we have been doing so far.
How much of new bank lines have you kind of got sanctions for? What is the amount that you have got sanctioned for in the last 2 months?
So 2 months we have got our one WCDL of 500 crore, which we have mentioned in our liquidity also, and the efforts are on with the bank to get. We have another 3,000 crore, around 1,000 crore bank lines available, which we will be able to draw it down. Apart from this, we have the sanction of full securitization from bank which is around 2,000 crore, already sanctioned line in hand.
Okay. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Prashant Podar from ADIA. Please go ahead.
Good afternoon, gentlemen. Thank you for the opportunity. So just in the last few weeks, obviously you would have also come across a lot of extra information that's there in the market. Could you just throw some light on the, how do we really look at the non-retail portfolio that you have? If you could give some details on that as to, in terms of how we process that bit of the book and become more comfortable on that.
Yeah, as I explained to you, the goal that we have set for ourselves is to bring down when you mentioned non-retail, I presume you are talking about the developer loan in particular.
Yeah.
And so from the developer loan point of view, which as we have said is about 22,000 crores of rupees at this point in time, we would like to bring it to 5% of the AUM asset under management over a period of time, with a very clear goal of bringing it down to 9,000-10,000 crores by March. So we're looking at pairing close to 10 to 12,000 crores of rupees. And as I told you, there are multiple objectives we have set, multiple strategies we have kept for that. We are very distinctly attacking few of the project loans in terms of creating an AF structure and helping the SRA projects to go down to that so that they could attract money from the market for future this thing. Keep supporting the developers who need the money immediately, but see to it that we are able to bring in either a joint lender or help them to migrate to a new lender altogether. So there are various options we are looking at, but then the desired objective is to bring it down to 9 to 10,000 crores of rupees by March. And we are confident, notwithstanding the challenges in the market with regard to a glut of developers' portfolio going around. And one thing that you need to appreciate is that most of the projects which we have lent so far are close to about 61% of completion stage. So that makes it a far more so. That's something that we feel is a very strong thing. And then we are the single lender, so the negotiating maneuverability is a little more pronounced in our case. So with all that, we feel that the next 5 months should see a lot of action on this ground. And I'm sure as we come to you on December and March, you will see actions taking off in a very perceptible manner.
So a quick question on that. So when you say 61% completion, this is the average completion of all the projects?
That's right. That's right.
Okay, and would you have some data on average inventory that would be sold in these projects as well?
Yeah, on average, these projects could also have an inventory. Of course, some of them could have an inventory as high as about 60-65%, but then overall, that's also in the range of between 50 and 60%. Half of them are sold. Only thing is, going by the current challenges in terms of booking sales, we have certain reasonably mid and large size projects wherein sales have taken place to the extent of 65-70%, but the actual registration is getting a little delayed because most of them want to do the registration on the CC stage, OC stage. So that's where, while the sales could have happened, the visible sale that is getting a little delayed, and that also is hampering the cash flow in a way. But then, going by the fact that these projects are 60 to 75% plus, we see that the cash flow should start coming in early January, February on these projects.
So given that you said for most of these you are the sole lender, just building on the question asked by another analyst, how does the incremental support which a lot of these projects would require, given that you are the sole lender, how would the incremental flow happen, and could that mean that that project gets stuck, or you may have to incrementally give in some money more to some of these projects?
I get the point. You see, as I told you, the amount that is left to be disbursed in respect of projects which are already sanctioned is in the vicinity of about 36%. Now, the question here is that what we essentially would do is that we will rework with the developers in terms of the amount that they have to prepay to me from the sale proceeds. We will elongate that prepayment of sales proceeds and allow them to recycle that within the requirement for completion of the projects. That's one strategy we have looked at, and hopefully, and wherever the sale is getting a little stretched, of course, there is no way but to handhold with them and see as to whether they can bring in another lender to take care of the requirement. But overall, the confidence level is that we should be able to help them through this by giving them a little more elongated thing to adjust the sale proceeds and make them use the entire sale proceeds into the development of the project to the completion stage.
So quickly, last question, which is, you did say that there are interests you're able to derive from participants who could be buying this portfolio. I also heard Mr. Vadhavan saying on the call on the channels that he is looking at, in fact, selling a large, sometimes selling also the a bulk of portfolios together. Now, what kind of investors are you attracting, or investors or participants are you attracting, and as a mark-to-market, because the interest rates have gone up in the system. So when you sell down these loans, do you envisage any losses on these portfolios?
It will be premature to say losses could be there, but then we will have to see the overall gain by pairing the portfolio and putting our overall objective of the retail listing. I may not be able to quantify the losses, but I don't rule out that there will be a bit of an haircut I may have to take. But then overall approach is how do I attract the investors? As I told you, there are two ways of doing it. One is my SRA projects, which are attracting a lot of joint development listing. So we will allow the existing developer to scout a joint developer and then bring them on board to see that they repay our loan and go ahead and complete the project, or repay a part of the loan and then put the remaining for a waterfall arrangement between us and the new joint development entity. That's one way of doing it. The other way is wherever the projects are upstream, 60-70%, we would reach out to the developers we have already as to whether they would like to go ahead and take a new investor. And there are certain portfolio investors who are willing to get into these kind of projects at 60-70% stage. I think there are a lot of interest on portfolio investors, and we would like to do that also. Both options are worked out, and we should be able to execute them ASAP between now and December and early January.
Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hello. Good afternoon, everyone. The first question is on the net worth reconciliation. On a sequential basis, I see your net worth is up by almost 525 crores, whereas the profit for the quarter is around 470 or something. Can you just throw some light on that?
Yeah. So, one thing I just want to tell you that this is the transition phase for the index. So, under ECL, the model is getting developed, model is getting established, and for that we have appointed the Deloitte, who are our implementing partner for the index. So, what the difference you are seeing is basically the true-up value for the ECL. Whatever ECL was worked out in the last quarter, and with this quarter, there has been some impact in the last quarter true-up value. So, the difference of that 47 crore is mainly because of the ECL.
But that transition-related stuff would have been taken care by end of FY18, right, when the transition actually happened. So, it would be opening net worth of FY18.
So what I'm trying to say is that from last quarter onward, whatever ECL has been worked out, on that there has been some true-up effect, and that true-up effect has been taken care of in this quarter's net worth. So this is within the accepted norms of the index, and this has been duly, reviewed by the Deloitte as an auditor. And the good part is that they are also our implementing partner for the index. So this is mainly because of that.
Okay, second question is, there is a line item in the P&L of around 513 million of net loss on derecognition of financial instrument. What does that pertain to?
Yeah, so that is basically when there was a liquidity required by us. We had some of the bonds and all that, so we have sold those bonds, and it was a losses on the bonds, and I will just give it to Bharat. He will give you the more picture.
So we have liquidated our investments, and these are part and parcel of liquidating our investment portfolio.
So these are actually realized loss, is it?
Yeah, these are realized loss.
Okay. And sequentially, while the assignment transactions have gone up, but the fair valuation on the net gain on the assignments have come off sharply on a quarter-on-quarter basis. Is it because the spreads were not favorable, or the back portfolio also got, on an NPV basis, got something because of that?
No. So if you look at, sequentially, what we have downsold in June quarter was more than the downsold in the September quarter. So the direct assignment amount in the September quarter was less than the direct assignment pool what we have sold in June. So this is mainly because of that. So this quarter, September quarter, we sold less than June.
And what was the amount in September and what was it in June?
exact number?
So exact number was 1,600 crore in the...
So in June the gross number was around 2,600 odd crores. 2,600 odd crores, and in the September quarter the gross number was around 1,998.
Yeah. Okay. Okay. So, but just from an understanding perspective, assuming that whatever you sell in the second quarter and the spread on that portfolio is lower, then do you also have to, on an NPV basis for the back portfolio, also you have to reduce the NPV, or whatever the transactions are done, those are crystallized?
Yeah. So that we have as a principle of index, whatever we are selling down in that particular quarter, we have to take NPV of that pool only. So it will not have the impact on that pre-quarter.
On the back pool. On the previous quarter portfolio, you won't have the impact. Okay. Okay, Said, another question is related to your repayment rate. Normally, you have around 4,000 to 5,000 crores of repayment in a quarter. So from a management priority perspective, what will have the priority? Repaying the liabilities, then disbursing with the same amount, disbursing the same amount of disbursements during the quarter, and or third, increasing the liquidity on the balance sheet.
So can you repeat your question? We didn't get your question.
So you normally on a quarterly basis, we have around 4,000 to 5,000 crores of repayment in a quarter, right? So whatever the money that you will receive, what would be the priority of the management? To disburse the equivalent amount? Secondly, to increase the liquidity on the balance sheet, or to repay the existing prepay the existing liability? At least in
basically, obviously, the first priority would be to honor our commitment. Correct. So whatever liability we have to pay, we would be repaying that first. Then, of course, we will create the liquidity by way of more borrowing, by way of whatever pool sell down we can do. And out of that money, we will utilize for disbursement. But we will not go out of the money just because of the disbursement. We will keep some money in the stock also as a liquidity. So I think your question has the answer itself, that first priority would be to pay all the liabilities, then create the liquidity, have the disbursements, and whatever left out we would like to keep the balance as a liquidity as well.
Okay, so in that case, considering the stress liquidity situation, is there a possibility that on a sequential basis, this quarter can see a meaningful in the sense at least 3-4% drop into the AUM in the third quarter?
You like to
no, you can't say because see on the while obviously on this quarter the disbursals are likely to be lower than the previous quarter, and that's a no-brainer. The fact remains that it's also through the industry, right? So the AUM drop typically accounts on two factors. One is the normal runoffs and amortization of the loans. The other is due to balance transfer and the prepayments going out. When the rest of the industry is also not disbursing component B, we'll have to wait and see how that spreads out. So to predict an AUM impact right now would be slightly presumptuous, because the balance transfers and the move-outs are also not happening. So I think we'll have to wait and watch to see how the impact of the AUM pans out.
Okay, let me rephrase my question. Would the disbursements be equal to or higher than the repayment or the prepayments that you will receive in the quarter?
See, Alpesh, as you would appreciate, we are still in the middle of the quarter. I think it would be appropriate for us to answer the question about the quarter post the quarter has ended. It's still 1.5 months to go, and you know, 1.5 months is a long time. You don't know how the situation will pan out. So as I said, it would be a little premature to answer this question or give any guidance on this question.
Okay, sure, and all the best.
Thank you. The next question is from the line of Love Sharma from Lombard Odier. Please go ahead.
Hello, hi. Thanks for taking the question. My question is coming back again to the developer loans on the book. So, if I understand correctly, there's definitely comfort from whatever you have said in terms of the projects being quite close to completion, and you're looking to work with the developers to ensure the projects are completed and to get your basically you to get the cash flows coming back. So, in that sense, why is the target of 9,000 to 10,000 crores of sell down of basically reducing this book by March 19? That sounds too aggressive. And especially considering that you mentioned there could be some losses as well on this book. So can you just wanted to understand why do you need to run it down so fast?
I mean, I don't think I'm running it very fast. I am running it in a phased manner. As I told you, we will, of course, if you are saying that running down close to 50% of the book over a period of next 5 to 6 months is fast, that is basically to keep in mind that we want to see that we put a very robust growth in the retail front, and we need to give a space for that. And we have taken into account the fact that going by the kind of scenario we are facing from banking and debt market, the best way to get liquidity is through the project downsell route. That's one way of doing it. Another one is that, you see, when you start doing such things, you can't do it in small pieces. You need to have a strategy, and we need to move them in bulk. Particularly, as I explained to you earlier, if I am taking an AIF route, I need to create a size of 2,000 to 3,000 crores of portfolio for an AIF to become very attractive. So from that point in view, unless I do a kind of a strategy on a critical mass, it wouldn't work out very well. So taking these two aspects, I think the phase which we have, the manner in which we are trying to run down the developer book is the most appropriate. I'm sure the time alone will say as to whether we were very aggressive or whether we were not very aggressive. But the fact is that I think we are quite on target to achieve that kind of numbers. On the haircut, again, as I told you, it's premature to say. I will definitely not say that there won't be any haircut, but I am sure we should be able to sustain that within our given book.
Okay, understand. And have you done any sell downs so far within this quarter? If you can indicate any number.
It will be a little too premature, but then I would say that we should do a reasonable number. Now that I have given you a target of I am doing a 10,000 crores between now and March, it should be a reasonable number towards that, very, very visible that we are very much online to achieve that target.
Okay, I understand. And just one last follow-up from me. Can you just comment quickly on the overall real estate sector as such? So, you being, you deciding yourself in terms of reducing this exposure to the developers, and pretty much, I think, similar across the board from most of the other NBFCs, HFCs as well. In that sense, and this is where most of the incremental lending has come for most of these developers, right? So, just wondering as to how have you been, are you concerned about, how does this lead to any systemic issues for these developers as to, who gives them the fresh funds to take care of their borrowings, cash flows, etc., given that, there's probably some cash flow shortage as well on some of the projects?
From an overall macro, I believe you are asking a very macro question in terms of how do I see the real estate developers portfolio and through the developers portfolio how the retail market is going to be. At this point in time, it is pretty fluid. We are looking at new project launch are definitely going to face uphill task in mobilizing unless you have deep pocket developers who have strategic kind of a funding route through FIIs and other things. But otherwise, because another thing, as I would like to mention all the participants here is that all the projects which are lent are all residential projects. I have no commercial projects with me. And on the residential projects, the increasing visibility of sale is only those projects which are cross 60% stages. And the initial stages, there are hardly any kind of bookings that we used to see in the S12. So there is bound to be a lot of difficulty in terms of launching new projects, and the funding requirement are definitely going to see a very different kind, because unless they are able to go to certain institutional investors, they are going to find it difficult to raise it from HFCs and HFCs and banks at this point in time. That's the way I see the market. And the fallout of that, yes, the loans to retail will also have its own kind of an ups and downs. But I think 6 months down the line, we should be able to see some kind of a reworking and realignment in the market space as to where the developers are going to get the money from. And my guess is that it is going to be a very, very kind of a broad-based approach. Maybe the fund route and the alternate investment route which I had mentioned would get revived, and that could be one route that the developers, good standing developers, can look at for raising money. The rest, of course, we'll have to wait and see as to how it pans out.
Okay, understand. And just one last thing as well. So, in terms of your discussions with, working with other financial institutions, etc., can you indicate what is the nature? I think it was asked earlier as well, but probably didn't get the answer. But what kind of investors are you seeing for these portfolios? Like if you have to sell these loans to somebody, I guess most of the NBFCs would probably be reluctant at this time. And banks, so is it mostly the banks where you see some interest coming from, or is it some other funds, etc., which are trying to take some of these loan portfolios?
Yeah, as I told you, I think I have answered that earlier too. You see, there are two ways we are looking at it. One is, like going by the stage, there are joint development interest that comes in. And joint developers are normally by leading developers who have a fairly good resource on their hand, who would like to enter this project at this stage and see it through the upward phase of sales and completion of the project. So that's largely we look at the joint development as the major this thing. The other one is, of course, take the investment route wherein there are institutional investors who are keen on taking a part of the project loan or maybe the full of the project loan if it is of a medium size, and fund that and take it forward from there on. These are the two routes that are basically available. We will not be able to reach out to another NBFC or another bank to take it. I don't think any of the banks are today in any position to get into a consortium lending. That's I don't foresee on a project loan on that at this point in time. But the routes are only largely these two, joint development and institutional investors.
Okay, understood. That's very helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Akash Dattani from HDFC Securities. Please go ahead.
Hello. Hello. Hello.
Mr. Akash Dattani, we can barely hear you. Could you please speak a little
can you hear me now?
Yes, please go ahead.
Yeah, so most of my questions are covered. I just have one question. So what is the take of the management on the NBFC sector receiving further funds from banks other than assignment sales?
Yeah, so basically, as you have seen, banks are now opening. When we are meeting them, talking to them, they may open the term loans also, term loan lines, and NCD they are doing, which you have seen, they have done with us and many others also. So of course there is a tough situation. There is a little bit not opening that much, but going forward they should give that term loan and all those lines should get open. This is how we foresee.
And so when do you see the situation improving for NBFCs? If you could sort of quantify it?
What do you mean by quantify meaning?
In terms of a timeline. So, say, 2 months from now or 3 months from now.
The timeline may be difficult for us to give because since the talk between RBI and government is going on, and as Harshil already covered in his speech, that just on 19 that meeting had happened and they have taken certain steps, more steps are yet to come, and then another meeting is scheduled in December. So post December we may be able to really quantify that within 3 months or 1 month or 2 months time.
Okay, great. Thank you so much and best of luck.
Thank you. The next question is from the line of Abhijit S. from Goldman Sachs. Please go ahead.
Thank you. The first question is on direct assignment again. Just wanted to get your sense in terms of, how the yields on this book have behaved before September and over the last 2 months. Has the situation gotten better over the last 1 month or so? So just some numbers.
Definitely, rates have moved up. They are considerably higher compared to what was there in September, but that was in line with the market rates. But the fact remains is that we are able to do sell down of a considerable amount. At the same time, all these pools are in the money in form of giving us the excess interest spread over a period of time. So we believe that even though amounts have increased, spreads have compressed, but the fact remains that they are profitable trades, and we are able to sell down at the size and the manner in which we wanted to. We believe that as the normalcy comes back to the market in terms of liquidity, we should be able to move back closer to our earlier spreads, but that only time will know. But as of now, there is very good interest, and there are multiple banks standing there to take these pools. We hope to get back to normal spreads.
So what would have been the spread differential before and after, if you can quantify?
There's a 50 to 70 basis point spread compression compared to earlier spreads.
And
not like to quantify exactly, but that's that kind of a spread compression which I can say.
And what's the EIS like on the book?
Sorry?
What is the question?
What is the EIS? So the excess interest, it used to be depend on the different pools and different pool characteristics. It used to range between 1 to 2%. It's now lower by 50%.
Okay. And so these direct assignments have been purely home loans or LAP as well? Any?
No, this includes both.
Okay.
LAP as well.
Yeah.
Okay. So the EIS is a blended one on both home loans?
Yeah, that's what I'm saying. It depends on the pool, so it's very difficult to put one to this. It depends on the pool and the characteristics of the pool. But it used to range between continue to be there.
Okay, and so second one is on the ALM. Given that the loan mix will now shift to longer tenor loans, how do you kind of plan to balance the ALM going forward? And the ALM table that you show, does that include the future expectation of sell down during the year? How do we read that table?
Yeah, so basically from ALM perspective, I want to address 2-3 points. One is that going forward, our ALM should improve because the CP, you would have seen that CP is hardly 1.5% of our total borrowing. So the short-term borrowing and that short-term stress is really gone out. And whatever now we are going to have, that would be the long-term, and that would match with the corresponding, year table. So the second question is about the pool sell down. Yes, that pool sell down has been factored in. What normally we do is that whatever book we have, we take the repayment of that mainly, and then based on the average, we have taken the repayment in that particular bucket.
And your assumptions have changed on repayment rates over the last quarter?
No, we have not changed the assumption.
Okay, and so the last one is on the divestment of non-core assets. Any progress?
So, non-core assets meaning you are saying from the
equity
loan book perspective?
No. Other holdings in the group.
Yeah, so with respect to the certain non-core assets, we have already initiated the process. Predominantly, this is all handled at the holding company level, which is Vadavan Global Capital. And what I'm given to understand from the holding company is that they have already initiated the process of divesting on certain non-core assets and identified also investment banker who has the mandate to take that forward. So clearly, as committed by chairman on divestment of non-core assets, the process has already been initiated, as we are given to understand from him, with identification of investment bankers who is already in the process of bidding exercise, and so that is on schedule and that is on target, as we are given to understand with respect.
Okay, all right. Thank you so much.
Thank you. The next question is from the line of Ashwin Balasubramaniam from HSBC Asset Management. Please go ahead.
Yeah, hi. In the presentation in September, you had kind of budgeted for about 2,500 crore of prepayments, repayments overall on a monthly basis, roughly. So, how much of that would have materialized? Let's say in October, November, would it be roughly on lines with what you had expected, or it might be quite a bit lower than that?
So, the numbers are a little lower. The fact remains that liquidity has materially dried up across the sector and across the NBFC. So, balance transfer have reduced considerably, and we used to be a hunting ground for a lot of NBFCs and banks for the purpose of balance transfer. So, that particular activity has slowed down, whereas the other normal prepayment continue to be there at the same rate. Yeah, definitely that number has shrunk. But that number is still closer to 1,800 to 2,000 crores. We expect it to come back to normalcy.
Okay. And in terms of the liquidity on the balance sheet, that again would be roughly similar to the September end number, or as in you had about 9,000 crore of liquid investments then. So is that something which you will going forward also maintain, or?
So the fact remains that we have drawn down from that particular liquidity reserve and utilized for purpose of repayment, as well as to sustain our part disbursements which were there at the time of this particular thing. But the fact remains is today still we have over 4,000 crores of liquidity buffer, and that we are looking forward to add more to that.
Okay, another repayments part, how much of that 2,000 odd crore which you mentioned would be prepayments and balance transfer, and how much would be normal kind of repayments?
So that's one thing is that so we have seen drop in terms of the collections and the main figure. We don't have an exact breakup which activity has given to this much, but the BT is considered to be one of the reasons why this number have dropped, but it's continued to be strong.
Okay, and on the project finance portfolio, you said like some significant portion would be, to SRAs and like the joint development kind of thing. So what would be the proportion which will be, those kind of projects, and what will be the remaining proportion?
It's 50-50.
50-50.
50% are SRA raised projects, 50% are, because my portfolio itself is close to about 70% are in Mumbai, 75% are in Mumbai. So it's around 50-50 on the SRA and non-SRA, and as I told you, average, all the projects are moved towards 60% of completion stage. With reference to the SRA project, it would mean that the SRAs are closer to almost 100% of completion, 80 to 100%. The sales projects will have to start off. That's the way.
And on the remainder of 50% also, you will be, like in most cases, sole lender, or...
Yeah, we are the sole lender in all the loans. There is not a single loan I have in my book where I am a joint lender. I mean, that's been a strategy. I mean, it's proving providential at this point in time.
Okay. Thank you.
Thank you.
Thank you very much. Due to time constraints, we'll take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Thank you very much. On behalf of Team THFL, ladies and gentlemen, thank you very much for joining onto the call for our Q2 results. We appreciate your questions and the free and frank interactive session around that. We understand that there are quite a few of you who have questions, but due to lack of time, we are not able to take those. However, if you have anything specific around that, please feel free to reach out to our investor relations team headed by Pranab and Ujjwal, and we shall, they shall be more than pleased to arrange the meeting if required, or a call, or they will themselves be in a position to respond back to your question to your satisfaction. Thank you very much. Have a nice day ahead, and we look forward to again interaction on the Q3 earnings. Thank you very much.
Thank you very much.